There's this huge disconnect at the heart of the US economy right now. I mean, on one hand, you have financial markets absolutely soaring, hitting all-time highs, just riding this massive wave of optimism. But if you peek just beneath the surface, the actual foundation of the economy, it's starting to show some serious cracks.
So that leads us to the big question, right? How in the world can the stock market be setting records when the job market is, well, on much shakier ground than anyone thought? It honestly feels like we're watching two completely different economies play out at the exact same time.
All right, so first up, let's dive into the bull case, because to really get a handle on this disconnect, you first have to appreciate the sheer power of the optimism that's driving this incredible market rally.
And the strength is it's remarkable. I mean, just look at the NYSE Composite Index. We're talking up over 20% for the year, trading right near its 52-week high. And this isn't just a handful of tech stocks anymore. The rally is actually broadening out, which, for investors, is usually a really healthy sign.
So what's lighting this fire? Well, it really all boils down to one thing: this widespread belief that the Federal Reserve is about to start cutting interest rates. The latest inflation numbers for August came in a little cooler than everyone was expecting, and that's basically convinced the market that the Fed has all the room it needs to act.
And it's not just the stock market that's feeling good. The bond market, which a lot of people see as the smart money, it isn't flashing any big warning signs about a recession either. Historically, bond investors are really good at sniffing out trouble ahead of time. And right now, they seem to be betting on more economic growth.
And there's even more fuel for this fire. You've got strong GDP growth in the second quarter, a really robust forecast for corporate earnings, and get this, a staggering $6 trillion just sitting on the sidelines in money market funds, basically waiting for a green light to jump into stocks. From this point of view, the party is just getting started.
Okay, but now, let's flip the script and look at the other side of this story. Because while the markets are popping champagne, the data coming from the real economy, well, it's painting a much, much different picture.
And this is where that disconnect gets so incredibly stark. The market is pricing in this perfect, soft landing. But the fundamental data? It's starting to suggest we might be flying on much shakier footing than we thought.
And this number is the bombshell. A recent government benchmark revision just revealed that 911,000 fewer jobs were created in the year through March than they originally told us. Just let that sink in for a second. Almost 1 million jobs that we thought were there just vanished from the data. That completely changes our understanding of how healthy the labor market actually is.
And look, this isn't just us saying this. Analysts are literally using phrases like this one to describe what's happening. This isn't some minor tweak to the numbers. It's a huge sign that the economic engine has been running a lot cooler than the official data led us all to believe.
And we're starting to see the pressure build up inside of companies. New research is showing that career growth is stalling out pretty much across the board. Promotions are down, companies aren't hiring from within as much, and what happens then? Your top talent starts heading for the door. This stuff is a leading indicator. It's a warning sign of future trouble for both how much people can spend and how productive companies can be.
And this right here, this just perfectly illustrates the whole disconnect. We just had a strong Q2 with 3.3% growth, which the market absolutely loved. But the official forecast for the entire year is just 1.6%. What does that tell you? It implies a really sharp slowdown is expected in the months ahead.
So how does all this conflict actually play out on the ground? Well, it creates this really clear divide, with certain sectors doing great while others are really feeling the pressure. When you look at the data, it's kind of like a scorecard, and it shows you the winners and losers in this whole disconnected economy.
Yeah, this divergence tells a totally different story for each sector. Tech is way out front, riding the AI hype train, but it's also where that employee anxiety is hitting the hardest. Financials are up because they're hoping for rate cuts, but they were also one of the sectors hit hard by those job revisions. And then you have sectors that are directly tied to the consumer and interest rates like real estate, and they are clearly feeling the strain.
Okay, so with this crazy, complex picture, let's just focus on what matters right now. What are the key risks we really need to keep an eye on, and what specific events happening today could tip the scales one way or the other?
So there are basically 3 big risks here. First, the market could just violently correct if reality doesn't live up to the hype. Second, the labor market could weaken even faster than we thought, and that would choke off consumer spending. And third, you could get a policy or geopolitical shock that just throws a huge wrench into the Fed's plans.
And this isn't some abstract theory. It's happening in real time. I mean, today, we're watching mortgage applications to get a pulse on the housing market. And earnings reports from big retailers like Zara and Chewy, they're going to give us a direct look at whether or not the consumer is still out there spending, despite all the pressures we've been talking about. And all of this brings us to the final and most critical point. Because this divergence, this giant chasm between a euphoric market and a fraying economy, it just can't last forever. So the crucial point is this: something has to give. It's that simple. Either the real economy has to somehow catch up to the market's incredible optimism, or the market is going to have to come back down to earth and face reality. That convergence, it's inevitable. And that leaves us with the ultimate question, doesn't it? When this collision finally happens, what's going to break first? Is it the market's rosy perception triggering a massive correction, or does the real economy somehow defy all this warring data and stage a surprise comeback? That is the multi-trillion-dollar question hanging over every single one of us.